Reflecting the withdrawal of policy stimulus last year and slowing global demand, growth will likely moderate to about 8%, to around 8% this year in China. We support the authorities' ongoing efforts to promote higher quality growth, while at the same time fine-tuning macroeconomic policies to help ensure that growth does not slow too much. We're also pleased to see that inflation, which was a major social concern last year, has peaked, and barring further shocks to food supply or global commodities, is expected to remain below 4%. The intensifying strains in Europe, however, highlight the significant downside risks to this outlook. China's timely and large stimulus in the years 2009 and 2010 succeeded in supporting domestic growth and shielded China's population from the worst of the crisis, the global crisis. And it helped global recovery by providing a needed lift to world demand. China again now has space for a forceful policy response if necessary, but this time the main line of defense should be on-budget fiscal stimulus. Measures should align with current efforts to distribute the benefits of China's growth more broadly across the population by supporting household income and consumption. The interest rate decision by the People's Bank of China yesterday confirms the authorities' commitment to achieving their macroeconomic objectives in the face of slowing growth and in the face of increased downside risks, especially coming from Europe. In the back row. We also welcome the step towards liberalization of interest rate margins that was taken. This will lower the cost of financial intermediation and allow market forces to play a greater role in the pricing of loans. Over the past several years, China's made significant progress in reducing external imbalances. The current account surplus, for example, has declined very sharply from nearly 10% of GDP in 2007 to a little less than 3% of GDP last year. And the real trade-weighted value of the renminbi has appreciated. With these developments, the undervaluation of the currency has been reduced. We at the IMF now assess the renminbi to be moderately undervalued against a broad basket of currencies. The external rebalancing has come in large part with an increasing reliance on investment. This fact brings with it a set of risks around the worthiness of those investments and the sustainability of this approach. As the government acknowledges, reforms are needed to achieve quality growth that relies less on investment, more on consumption, and is environmentally friendly. In our view, these should include measures to raise household income, liberalize the financial system, strengthen the social security system while also lowering social contribution rates, appreciate the exchange rate, and increase the cost of various inputs to production. These priorities feature in the 12 five-year plan, and we believe timely implementation will be key. The reform process should go faster to avoid a further buildup of risks, produce a smooth and controlled adjustment to consumer-based growth, and contribute to the rebalancing of the global economy. Without these reforms, domestic imbalances could at some point unwind in a disorderly fashion and trigger an abrupt decline in investment.